Confused about saving for retirement? You've probably heard of Roth IRAs and 401ks. They're both powerful, but understanding their differences is key to maximizing your retirement nest egg. Let's break down which one might be better for you. First, the 401k. This is typically offered through your employer. Money goes in pre-tax, meaning it lowers your taxable income today. Your investments grow tax-deferred. You only pay taxes when you withdraw in retirement. Plus, many employers offer a matching contribution, which is essentially free money. Don't leave that on the table. Now, the Roth IRA. This is an individual retirement account you can open on your own. Here, money goes in post-tax. You pay taxes on it now, but then your investments grow completely tax-free, and your qualified withdrawals in retirement are also tax-free. No taxes ever again on those gains. So, which is better? It really comes down to when you want to pay taxes, now or later. If you expect to be in a higher tax bracket in retirement, a Roth IRA makes sense, paying taxes now at a lower rate. If you're in a higher tax bracket today and expect to be in a lower one later, a 401k could be more beneficial as you get that immediate tax deduction. Consider your current income, your expected future income, and whether your employer offers a 401k match. Both are excellent tools. The most important thing is to start saving. Even small contributions add up over time thanks to compound interest. For more clear financial breakdowns, subscribe to Moneymaker Studio and let's build your wealth together.